Hello, this is Dr. Wright here. For this assignment, I want to show you how to create a bond pricing calculator in Excel. Now, I will admit to you right out of the gate, Microsoft Excel has some very good, very functional black box formulas that you can use in order to figure out the price of a bond. What I mean by that is it doesn't have to take as long as it's going to take us to do this Excel assignment in order to figure out the price of a bond. However, I feel that it's important before you start using black box functions in Excel. I think it's really critical that you understand what's going on inside the black box. So we're going to peel the top off of the black box today. We're going to peek inside of it. We're going to get our hands dirty inside the box. After you do this assignment, you'll never have to do what you do inside the black box again. It's only for this assignment. I want you to look in the black box, get very comfortable with what's happening in there, and then from today forward you can just use the black box and have a lot of confidence that you know that it's right and you understand what's happening on the inside of it. So let's get to it. You can see I have bond pricing and duration calculator. We're only doing the pricing part today, so we're not going to need some of the variables, but I'll just leave them on here. Whatever we don't need, we'll just ignore for today. So anytime you're going to have a bond, you're going to have certain inputs that are required. You need to know the principal, the coupon rate, the yield to maturity, the maturity date, and then we're going to need to know the settlement date, the previous coupon date, the next coupon date, and the payments per year. Most bonds have a principal payment or a par value of $1,000. We're just going to put in a coupon rate for us to work with as we're creating the pricing calculator. So I'm going to put in a 7.2% coupon rate, 5% yield to maturity, and we're going to assume that the bond makes semi-annual coupon payments. Just to start out, I'm going to put in a maturity date of October 2nd, 2015, and I'm going to put in a settlement date of August 15th, 2012. Now, for our purposes, you actually don't need this if you're just using the black box formulas, but for our purposes, we actually need to know the previous coupon date and the next coupon date. Well, if the bond matures on October 2nd, then you can bet that there's a coupon payment on October 2nd every year, and then there's a coupon payment every 6 months in between. So if you go 6 months past October, you have November, December, January, February, March, April. So that means that the previous coupon date for this bond would have been April 2nd, 2012, and the next coupon date is October 2nd of 2012 on the anniversary of the bond's issuance. Okay. With those inputs, you can go ahead and go straight to the black box functions in Excel. So over here you can do quoted price. All you have to do is type in price, and it asks for some inputs. First thing it needs is the settlement date. That's the date on which you are buying or selling the bond. It needs the maturity date. It needs the rate, which is the coupon rate. It needs the yield to maturity. It needs to know the redemption amount. Now look, you could put in $1,000. That's what the redemption amount is. However, I'm going to have us put in $100, and you'll see why. So I'm going to put a redemption amount of 100, and for frequency, it wants to know how often the coupon payments are made, so we put in twice per year. Hit the enter button, and what that tells you is if the redemption value of the bond was $100, then the price of the bond right now would be $106.2942. The reason I had us put in $100 of the redemption value is that most bonds, when the prices are quoted, they're quoted as a percentage of par value. So when you put in 100 as a redemption value, what this spits out is percentage of par value. So this bond should be trading at 106.2942% of par value. If you want to translate that into an actual dollar value, you would just take your percentage of par value right there, divide it by 100, and multiply it by the actual par value or principal. So this bond should be trading at $1,062.94. Now that's the clean or the flat price. In other words, that's the value of the bond. However, you're going to have to pay more than that in order to acquire this bond. The reason you will have to pay more than that to acquire this bond is because the very first interest payment you get, which will be $36 because it has an annual coupon rate of 7.2%, which is $72, but it makes semi-annual coupon payments. Therefore, $72 divided by 2 means you'll get a coupon payment of $36 on October 2nd of 2012. But the thing of it is, you don't deserve all of that. If you think about it, the person who sold you the bond has been holding that bond since April 2nd when the last coupon payment was made. It's now August 15th. That's a fairly good chunk of time that's elapsed. So the person who's selling you that bond feels as though he or she is deserving of a fairly good chunk of that first interest payment. So what you're going to have to do is when you get that first interest payment, actually not when you get the first interest payment, but it's a good way to think of it, you're going to have to pay the seller of this bond up front that accrued interest that they think they deserve. Well, how much interest do they think they deserve? Well, we know that the total coupon payment will be $36, so the question is what percentage of the coupon period were they holding this bond? So we need to figure out what percentage of the coupon period the person selling you the bond was holding the bond. In order to do that, I'm going to use the days 360 function. Days 360 allows you to calculate how many days have elapsed between two dates, assuming there are 360 days in a year. Most corporate bonds make the assumption of 360 days in a year. That's why we're using this function. So I take days 360, I go to the start date, which was the last coupon payment, and then I go to the settlement date. That's going to tell me how many days have gone by. So 133 days have elapsed since the last coupon payment. Well, what percentage of the coupon period does that represent? In order to get that, we're just going to divide it by, in this case, days 360, and let's do a full coupon period, which would be April all the way to the next coupon payment. So that's a full coupon period. We want to see what percentage of that the person that's selling us the bond has been holding the bond. So it turns out that the person has been holding this bond for 74% of this current coupon period. So the person selling us the bond believes that of the $36 we will receive at that first coupon payment, he or she believes that they are deserving of 74% of that. So we're just going to multiply that by the coupon payment. $1,000 times 7.2% divided by 2 payments. So you can see the accrued interest on the bond is the $36 times the 74% of the coupon period, during which time the person that's selling us the bond was holding the bond. So basically, we're going to have to give that seller 74% of the initial coupon payment right when we buy the bond. So that's the value of the bond, but we're going to have to tack on the $26.60. So in order to get the invoice or the dirty price, you could just take the clean or the quoted price and you could add the accrued interest. That's how much you would actually have to pay to get into this bond. Okay, that's the simple, quick and dirty black box method of pricing a bond in Excel. After you do this assignment and you get comfortable with what's in the black box, feel free to use the black box functions. That's why they're there, is to make your life easy. However, like I mentioned earlier, today I want us to peel off the lid from the black box. Before you use it on a regular basis, I want you to be confident with what's happening inside of it. So I'm going to delete that and we're going to calculate our own invoice or dirty price. Keep in mind that the price of a bond, before we get going, the price of a bond is nothing more than the sum of the present values of all of the expected future cash flows. So it's really only a 3 or 4 step process. Step 1 in pricing a bond is to map out the cash flows. Step 2 is to figure out the discount factors that you will use to find the present value of each of those cash flows. Step 3 is then to find the present value of all of those cash flows. And then step 4 is to just add up the present value. So that's all we're going to do. But I want you to understand that we're going to make this a very dynamic spreadsheet. In other words, I want to make it so that we only see cash flow data in this table down here. If we actually want to see cash flow data, what I mean is I only want to see cash flow data up to October 2nd of 2015. I don't want to see any zeros or any other content once I get past that date. So we're going to do some if-then statements to make that happen. It's going to be very simple, and I'll try to walk you through it slowly. Let's just do the first row, however, and the first row is very, very straightforward. The date is just going to be the next coupon date, which we already have, so we can just link straight to that. We need to know how long that period represents. In other words, if the settlement date is August 15th and we're going to get the first coupon on October 2nd, That means we need to discount back whatever cash flows we get on October 2nd back to August 15th. So what percentage of a full coupon period does that represent? Well, I'm going to go days 360. My start date is the settlement date. My end date is the next coupon date. You can see that's 47 days. I'm going to divide that by a full coupon period. So again, we'll use the days 360 function. And our start date would now be the previous coupon date going all the way to the next coupon date. And so you can see that, so we're settling the bond on August 15th. We're getting the first cash flow on October 2nd. That means that 0.26 or 26.1% of a full coupon period will have expired by the time we get the first cash flow. So that's going to be important as we figure out our discount rate. Now, what's our interest payment going to be? It's going to be the principal times the coupon rate divided by the number of payments per year. We're not going to get any principal in the first period. What are the total cash flows from the bond? Well, the total cash flows will just be the sum of the interest and the principal. Obviously, in this case, it's just going to be the interest. Now, to get our discount factor, remember, when you want to find the present value of a cash flow in the future, that cash flow goes in the numerator, and in the denominator, you take 1 plus the periodic rate raised to the number of periods. So our periodic rate in this case would be the yield to maturity divided by the compounding periods per year, and we need to raise it to the total number of periods. Well, in this case, we don't have a full period. We have a fraction of a period. In fact, it's 26.1% of a full period. So there's our discount factor. Now, as a side note, when you figure out discount factors, you can either do what I just said, take 1 plus the periodic rate raised to the number of periods, or you can take 1 plus the annual rate raised to the number of years. It doesn't matter which way you go, but you must be consistent. Periodic rate raised to the number of periods, or annual rate raised to the number of years. You cannot mix and match. So to get the present value, then, we just take the expected cash flow, divide it by the discount factor, and we actually don't need these last two columns. We'll use that when we do the duration calculator, but for now we can ignore those. All right, now we want to fill in the rest of the table, but like I said, we want to make it dynamic. We want to make it so that we only see data in this table if we are prior or equal to the maturity date. So we're going to do some if-then statements. But before we do some if-then statements, let me introduce you to a function. There's a function called eDate where I can take a starting date and then just add months to it. Well, I want to take this date and add 6 months. So I'm going to take 12 divided by my payments per year, and you can see that gives me the next coupon payment. But we want to craft the formulas in this table such that we only see content if we really need the content. So I'm going to create an if-then statement. I'm going to say if the eDate, so if I take this previous date and I add 12 divided by the payments per year, so if I take that, if it's less than or equal to my maturity date, then I want to see that eDate. I actually want to see that next coupon date. What if that's not true, however? What if Excel takes this previous date, adds 6 months, and now we're past the maturity date? If that happens, I don't want to see anything in this cell. How do I tell Excel to put nothing in a cell? Well, Excel will put anything in a cell that is in between quotation marks. So whatever I put in between quotation marks could go in that cell. So if I don't want anything in the cell, I just put nothing in between the quotation marks. So make sure you're comfortable with this formula. We've told Excel, take the previous date, add 6 months to it. If that's less than the maturity date, then show me that date. That means I need a coupon date there. However, if you add 6 months to the previous date and it's greater than the maturity date, then I don't want to see anything. That means we're past the maturity date. We need to include some absolute references. In other words, when I drag this formula down, there are certain cells that I don't want to drag. Specifically, any references to this to or this maturity date I don't want to drag, so I'm going to put in absolute reference by putting a $sign in between both the column and the row. Not necessary in this case to put the $sign in front of the letter, but it won't hurt us, so I'm going to go ahead and do it. So everything in the input table I've turned into an absolute reference. Now, we're going to run into an issue with this. Let me show you what the issue is. You can see we reached maturity. It gave us a blank cell, the next cell. That's great. And then it gave us a bunch of error messages. The problem is we have confused our good friend Excel. We have told it in this cell to go to the previous cell and add 6 months. Excel went to the previous cell and saw a blank. Excel said, I cannot add 6 months to a blank cell. So we need to come back in and nest this in another if-then statement. What we're going to do is say this. We're going to say if the previous cell equals nothing, then obviously we don't want anything in this next cell. If, however, there is content in the previous date cell, go ahead and do the original if-then statement that we created. So it's a nested if-then statement, not terribly complex, but you may want to take a minute to make sure you're comfortable with it. Again, we're just saying if the previous cell equals nothing, then we want nothing in the current cell. If, however, there is content in the previous cell, then do this if-then statement that we crafted earlier to create the next coupon payment if we're inside the maturity date. Now we should be able to run that down and get rid of those error messages. Now I would like you to create a bond pricing calculator that can handle bonds that have 30 years to maturity and make semi-annual coupon payments. So let's do that. I'm going to set my maturity date 30 years out, and I'm just going to drag our formula down as far as it needs to go in order to make it work. And so there it is. All right, now for the period. This is very easy because from this point forward, after that first coupon payment, every coupon payment that we get will represent one period that has elapsed. So all we have to do is this. If the date equals nothing, then give me nothing. That means we're outside of the maturity date. If, however, there is a date, just give me the previous period plus 1. Don't need to lock anything in. No absolute reference is necessary there. Should be able to shoot that on down the line, and it will stop as well when it needs to. Great. For interest, similar concept. If the date equals nothing, give me nothing. Otherwise, give me principal times coupon rate divided by payments per year. All of those are in the input table. They're going to need to be absolute reference. We do that. We shoot it on down the line. Principal, similar concept. We're going to say if date equals nothing, give me nothing. Otherwise, if the date equals the maturity date, then give me the principal. Otherwise, give me 0. Make sure you're comfortable. Again, it's a nested if-then statement. First if-then. If date equals nothing, give me nothing. That means we're past the maturity date. If, however, there's a date, if it's equal to the maturity date, give me the principal. Otherwise, don't give me anything. We'll be able to check this very easily. Scroll on down, and you can see I did it wrong. I made a mistake, right? That should be $1,000 at the end. I know exactly what I did wrong. It's good for you to see the mistakes. Forgot to do absolute reference. Any of these input cells need to be absolute reference. So B7, B4 need $signs in front of them. You can see when I dragged that formula down, it turned into B8, B5, B9, B6, B10, B7. Not good. That's not what we wanted. So right there, let's go ahead and lock it in. Absolute reference. That's going to fix it. All right, we're good to go. For total cash flows, again, similar concept. We're going to say if the date equals nothing, give me nothing. Otherwise, give me the sum of these two cells right there. Should be good to go on that. Double click down. Discount factor. Again, if the date equals nothing, give me nothing. Otherwise, give me 1 plus periodic rate. That's yield to maturity divided by payments per year. Raised to the number of periods. Should be good to go. Shoot it on down the line. Absolute reference. Come on, Dr. Wright. What are you thinking? Absolute reference, brother. B6, B11, both need the absolute reference. Shoot it on down the line. Looks much better. Present value, similar logic. If the date equals nothing, give me nothing. Otherwise, give me the cash flow divided by the discount factor. Don't need to lock anything in there. All right, now at this point, sanity check. Do those numbers look like they're reasonable? I don't know. How would we figure that out? Well, you know that if you have a constant nominal cash flow coming at you each period, so it's the same amount every period, but each period is getting farther and farther into the future. Well, we know that the farther out you push a cash flow, the lower its present value should get. So we can see this present value steadily declining. That suggests to me that we did this correctly. Therefore, in order to get the price of this bond, all you have to do is add up all of these present values. Turns out, however, that this is going to give you a dirty price, not a quoted or clean price. Why is that? Because what we've done here assumes that you get to keep all of this interest. So, in fact, this analysis is assuming that that $36 all gets to stay in your pocket. Therefore, it's a dirty price. Okay? So we're just going to add up all of these present values, and you're going to see it'll give us a dirty price here. Okay, so $1,367.15. Now we calculated accrued interest earlier using a different methodology. What we did earlier, remember, was we said, okay, how much is a coupon payment? $36. And we said, what percentage of this initial coupon period is the previous bondholder entitled to? And I don't remember, I think it was 74%. So we found out that 74% of this initial coupon payment actually belongs and is owed to the previous bondholder. Well, another way to get the accrued interest is to just take my dirty price and subtract out my clean price, and you can see it's the exact same number. Now, why did we do it both ways? We did it both ways to prove to ourselves that the black box works. Now you've seen in the black box, now you've double-checked the work, now you know it's right. See, that's the value of the bond, assuming you actually deserved all the cash flows. That's the value of the bond, assuming you don't deserve all of that initial cash flow. Well, the way that it actually plays out is you do get to keep that $36. Nobody's going to come pry any of that money out of your bank account. You get to keep it. So, okay, that's the value of the bond. Unfortunately, right, you're going to have to pay some of that to the bondholder right when you make the transaction. So that's dirty price. That's the value of the bond, assuming you get to keep all of it, which you do get to keep all of it. So that's why that's your dirty price. So, okay, you might be saying, well, why don't they just quote it that way? If I get to keep that, and that's the value of the bond, if I do get to keep that, why don't they just quote it that way? Well, because in their eyes, that's not really a part of the bond. Yes, you get to keep the $36, but 74% of it isn't really yours. And since it's not really yours, let's not value the bond as if it is. It's deceitful. So that's the undeceitful way to value the bond. It just turns out that you're still going to have to pay it up when you buy the bond. So just need you to understand, that's what you're going to see in the financial press. That's what you're going to pay for it. All right, we're almost done. Let me show you just a couple other things here. I want to show you conditional formatting. What do I mean by conditional formatting? Well, let's peel this back. Let's go back to October 2nd, 2015 as our maturity date. So October 2nd, 2015. You can see this is a very dynamic calculator now. There's no content showing below that maturity date. But I'd also like to make this readable. I want to put some boxes around this. So let's just highlight everything that might eventually have content in it. Because remember, you could have a bond that's a 30-year bond, and if that were the case, all of these cells would have content in it. Highlight all those cells. Go up to this icon, which is on the Home tab. It's called Conditional Formatting. And we're going to select a new rule. Now, before I talk about this, I want you to understand conditional formatting is a very nifty little thing in terms of making your spreadsheets more readable. I don't think you ever want to make your spreadsheets artistic or flowery. I think you want to spend as little time as possible, but you want to make them as readable as possible. Conditional formatting can really help with that. Once we've gone into conditional formatting, we're going to format only cells that contain, and you can see down here, one of the options is no blanks. How do we want to format it? Well, I just want a simple box around it. So you can see one of the tabs up here is border. I'm going to outline it, click OK, and now you can see there's borders around it. If you change the maturity, so what if I go 10/2/2017? You can see now not only does the content fill in, but you can see that also it's got boxes around it. Okay, so that's conditional formatting. Now again, you can use the quick and dirty, the black box formulas. That's what they're there for. Do it fast, get it done, don't spend a bunch of time on it. But I want you to do this. I want you to peel the top off the black box. I want you to dive in, create this longer version of a bond pricing calculator. By the way, this isn't entirely a useless exercise. Keep in mind, you read in the book about something called strips. This is where they actually strip out the principal from all the interest payments. So you can do this. You could actually strip out all these interest payments and sell them as their own assets, or you could combine them and create what's called a structured note, which is basically a hybrid bond that you create by stripping out cash flows from all these other bonds and then rebundling them. So for instance, this $36 to be received April 2nd of 2015, in your eyes, that's worth $31.61. So if you could get somebody to pay you $32 or $33 for it, go for it. Strip it out and sell it and make a profit. So this isn't entirely useless. You can use this to give you information on your strips. But what I want you to do is I want you to use this calculator to get comfortable with some of the basic principles of bond pricing. What are some of the basic principles of bond pricing? First and foremost, inverse relationship between yield to maturity and bond price. As yield to maturity goes up, bond price goes down. Check it out. Here's the clean price. Here's my yield to maturity. I'm going to jack it up to 8. Watch what happens. Bond price goes down considerably. And the inverse holds. If yield to maturity goes down, bond price is going to go up. Watch bond price. Bond price goes up. Other very foundational principles of bond prices, the relationship between the coupon rate and the yield to maturity, which is correlated with the relationship between the price and the principal. Note, if the coupon payment is above the yield to maturity, this is an attractive bond, it will sell at a premium. If, however, the coupon rate is below the yield to maturity, it's now no longer an attractive bond relative to the market option, and it's going to have to sell at a discount. Also, you could demonstrate to yourself that the longer the time to maturity, you're going to get wilder price swings. What do I mean by that? Well, right here you have a clean price of $927.16. If the yield to maturity goes up by 1%, you can see it goes down to $889.55. Let me put that back. So, okay, that's a decrease of roughly $40, give or take. But watch what happens if you turn this into a longer maturity bond. So what if you do October of 2042? Okay. Now we notice already that the bond price has become more extreme, which is another fundamental principle of bond prices. The longer the time to maturity, the more extreme the bond price. What do I mean by that? We knew this bond was already selling at a discount because the yield to maturity was higher than the coupon rate. That means it's an unattractive bond. It's selling at a discount. Once we made it a longer bond, time to maturity was longer, price got more extreme, discount got bigger. But what I'm also, and it works on the flip side too, what if the coupon rate was higher than the yield to maturity? Well, you could see that the premium would be higher as well. So the price is more extreme. Either the premium's bigger or the discount's bigger as the time to maturity gets extended. But what I wanted you to see is you get wilder price swings as well. Remember, when this was a shorter term bond and I increased the yield to maturity by 1%, the price declined by about $40. And I'm probably off on my math there, but that was just back of the envelope stuff. Now watch what happens if you increase the yield to maturity by 1%. The price goes from $813.94 down to $734, so it loses roughly what, $80. So all I'm saying is longer time to maturity, you get both more extreme prices and also higher, wilder swings in the prices of the bond as the yield changes. So a couple purposes for this assignment. I want you to get comfortable and confident in the black box formulas that Excel gives you that are very useful. I want you to create something that could be used to price the strips if you're going to strip out the interest rates. And I also want you to use this calculator to get comfortable with the basic principles of bond prices that I just explained. I hope the tutorial is helpful. I hope you feel like you can recreate it successfully, not just recreate it, but understand both the finance principles and the Excel concepts that we used. If you need any help, come see my TA or you can come see me. Best of luck with it. I'll see you in class.